All right, welcome, new partners. Today we're going to break down the single most dangerous habit in venture capital, pattern matching. Think of this as a masterclass designed to completely reframe how you hunt for that next generation of truly transformative companies. Now, this feels pretty obvious, right? And yet, what's our deepest instinct as investors? It's to pattern match. We're always on the lookout for the next Google or the Uber for X. It's a comfortable habit. It feels safe, but honestly, it's a trap. To break that habit, we have to flip our whole approach on its head. We need to move away from those compelling narratives and the nice, neat stories. That's what we call the inside view. And instead, we need to embrace the cold, hard data of what has actually happened. That is the outside view, and that's where the truth really is. So let's get right to the data. We dug into 3 decades of tech returns. We're talking over 300 major companies that created a staggering $13 trillion in value. And what this mountain of data shows is a very simple truth. In venture capital, averages aren't just useless, they are dangerously misleading. Out of all those 300-plus companies, I just want you to focus on one number to start. Just one. 7. Because those 7 companies, well, they alone created this incredible share of the total value, 49.8%. I mean, look at that. That is the power law in brutal, beautiful action. Just 7 anomalous, outlier companies drove almost half of all returns in the entire dataset. This is not a game of averages, folks. It's a game of anomalies. So here's the absolute crucial point. Your job is not to find companies that fit a familiar pattern. It's to find the ones that break the pattern completely. The very act of pattern matching actually biases you against finding the next true outlier. Okay, so if we're hunting for anomalies, where do we even begin? Well, the first step is to stop guessing and start understanding the statistical likelihoods, the base rates for different types of investments. You have to know what kind of game you're actually playing. This table here really breaks it down. First, notice that enterprise software produced almost twice as many successful companies. Okay, fine. But now look at the slugging ratio. That's just the total value created divided by the number of companies. And here, consumer and hard tech are the absolute champions, generating way more value on a per-company basis. And this chart just makes it crystal clear, doesn't it? Think of it like this. Investing in consumer tech is a grand slam game. You're swinging for the fences, hunting for those massive winner-take-all network effects. Enterprise is more about getting players on base. You get more winners, but the average outcome is lower. They're different games, and they have different rules. Now, let's use this data-first mindset to go bust 2 of the biggest, most dangerous myths in venture capital. The idea of these impenetrable technical moats and this obsession with predictable market sizing. So the first myth is that having unique technology is the ultimate defense. But as Vista Equity founder Robert Smith so perfectly puts it, most enterprise software is, well, it's pretty similar under the hood. So what does this mean? It means the real durable moat often isn't the code itself. It's the go-to-market strategy, it's the brand's mindshare, and it's just relentless sales and marketing execution. I mean, when competitors can copy your features in a matter of days, the ability to sell and build that loyal customer base becomes the real differentiator.
And the second myth? Oh, it's our obsession with market size. Our desire for certainty makes us demand a TAM slide, but this leads us to dramatically, laughably underestimate true category creators. Seriously, just think about it. How would you have sized the market for Uber back in 2010? You would have been so wrong.
We get this wrong consistently for pretty much 3 reasons. 1, we fail to see how a new product can actually expand the market it's entering. 2, we underestimate how a totally new business model can unlock value. And most importantly, we fail to see how a single product can evolve into a multi-product platform, basically creating its own market as it grows. So if these winning companies are such outliers, where on earth do they come from? They don't just pop up out of thin air. No, they are unlocked by these fundamental, once-in-a-decade shifts in technology. You can literally see it happen again and again. Each new tech wave creates this narrow window of opportunity for a new type of company to just explode. The internet gave us aggregators like Google. Mobile put a computer in everyone's pocket and unlocked marketplaces like Uber and Airbnb. The cloud made it possible to build software with just a credit card, which created the whole SaaS boom. Today's AI wave is a little different, though. It's automating these core business workflows that software couldn't really touch before. For example, In our entire dataset, we had 0 legal tech companies valued over $5 billion. 0. Yet Harvey, an AI-native legal company, hit that valuation in just 3 years. That's a technology wave creating a whole new market right in front of our eyes. Okay, so this brings us to the very heart of the matter. Your mandate as a partner at this firm. This is where we pull everything together into a new call to action. You have to constantly fight that temptation to force the future into the patterns of the past. As the Durants wrote, history is complicated, it's messy, it breaks all our rules. And you know what? The exact same thing is true for technology and for the companies that define it. So here it is, your new mandate. First, really understand the base rates of the category you're looking at. Second, figure out where the true differentiation is. Is it really the tech, or is it the execution? Third, use first principles thinking on market size. Don't just get hypnotized by a TAM slide. And finally, and this is the big one, you have to learn to embrace anomaly and uncertainty, because that is exactly where the power law returns are hiding. So I'll leave you with this one question to guide your work every single day. Your job is not to find what's comfortable and familiar. It's to find what's strange, what's new, and what is undeniably different. Your job is to find the next anomaly. Thank you.